Bank of America and Morgan Stanley, the latest of the major U.S. banks to report quarterly results, posting fourth quarter profits that more than doubled. While the collective full year net income of the six major banks saw a 19% rise in 2024. Here with more, Ken Leon, CFRA Director of Global Fundamental Research. Ken, when you look at the banks here, is this as good as it gets, or are we looking at an outlook, particularly a regulatory environment, that could propel them even further?
Yeah, so this is just the beginning. Our view, really even going back to November, is stay the course. What we're going to see this year is an opening up of markets. We're going to see the consensus revise their earnings upward, not once, but several times, mostly because of the increased volume across multiple businesses. Very positive for the capital markets after the six global U.S. banks reported. We also saw very good activity with elevated equity market. Client balances and fees off of that were also very high, as noted from Morgan Stanley and Bank of America.
Ken, net interest income, generally speaking, Ken, what are you seeing now and ahead?
Net interest income, it was very bearish from the street back in September, October, but with a U.S. economy growing 2.5%, there's two sides of what gets you to net interest income. One is rates, which maybe we'll say stays or goes one cut, but the volumes off of a U.S. economy growing 2.5% is very positive. So I think net interest income, more of a factor for the traditional banks. It's about 55, 60% of total revenue, but for Morgan Stanley or Goldman Sachs, 15% of total revenue. Really not a factor.
So let's talk about the more traditional banks and that side of the ledger there, because if, as you say, the economy is expanding, if their margins are getting crimped at all because of the net interest margin, would they need then to see a pickup in loan demand? I know, for example, Jamie Dimon was talking about that there had been sort of a lack of loan demand. Do you expect the pickup to come?
Yeah, so my point again was volumes is driven by the U.S. economy, loan volume, other transaction treasury service volumes. Rates, if you get into the bowels of NII, net interest spreads, and even year over year, it's been really not that much in terms of rates coming down. I'm not too worried really about net interest income, but if you're looking at, I don't cover traditional banks. I cover the six greatest U.S. global banks. They're diversified, and they represent a significant part of the top 10 constituents of being overweighted in the financial sector, which is where CFRA is. You want to go downstreams to smaller regional banks, could be a bigger issue if you only have 1% growth on commercial or consumer loan growth.
Ken, Trump is back. What does that mean for your coverage universe? What does that mean for the banks you cover in terms of regulatory backdrop, capital requirements?
Well, we have new actors in important roles, not only at the Fed, but across all of the organizations, whether it's the FDIC, the Department of Justice, the FTC. This will open up markets, particularly for financial sponsors, private equity, which has $1 trillion they have to monetize, possibly IPO or M&A. Additionally, what we're going to see is more of a pro-business, pro-economy environment. We haven't had that for 4 years.
I guess sort of the Basel endgame and the Basel requirements are sort of a dead. It seems like the banks won that argument, maybe even before Trump came into office.
Yeah, so there's the annual capital stress tests. We also have the Basel III endgame, where the hysteria of 18 months ago was a capital build, increasing your capital for overcapitalized banks that I cover by 20%. Maybe it's 5 to 7%. It's kind of murky, but I think that's really something in the rear mirror, not a risk for investors.
Ken, good to see you. Thank you so much.
Thank you.